This is the Econ Americas podcast. Fergus Hodgson, your host. If you've not already, please subscribe at econamericas.substack.com for full access. And I'm chatting today with someone I've followed for many years. I think it was 2011. I heard him speak at the New Orleans Investment Conference, and so I've followed his work ever since then. At that time, he was this young whiz kid from Canada, and now he is an expat in the Bahamas. I'm not sure if you were already there at the time, but so this is David Skarica, and his latest uh, iteration or website is profitfrompessimism.com, where he's got a long time subscription service with both free content and subscriber content. And we're speaking today because on April 22nd, which will probably be tomorrow when this comes out, he will be releasing his book, or his book will become available on Amazon. And it's called Mega Returns: Profit from Maximum Pessimism. And I love the hyperbole.
It's from Sir John Templeton, who actually also resided in the Bahamas, and that's what he used to say: you buy at the point of maximum pessimism. So, and I've always believed in that kind of contrarian approach, and so I'm just taking a line out of him. And I guess when I rebranded from Addicted to Profits, I still had the word profit in there, right? So
Yeah, well, it's so funny because the book obviously took you, and I've been reading through a preview copy, and you were writing it about a year ago, I guess, and it's just timing has been so on your side that I don't know if anyone could have predicted this like kind of awkward pessimism, this era that you're going through, which is impeccably timed when the book is coming out.
well, here's what's really funny. The book actually I started it in 2019, right? And then COVID happened. So I had to rebrand it because of that, because all the money printing and spending that went on. And then inflation started to take off. And Newsmax, this is their publishing arm that's publishing it. And Chris Ruddy, the CEO, is also a friend of mine. He was really concentrated on building up the cable news division of the company. And then the company obviously just went public recently. So they were focused on that, not really so much the financial publication arm anymore. So it kept rebranding and rebranding. And of course, Newsmax, because it's a big political, they're a right wing, conservative website. Election years are their big years. So then we weren't going to publish it during an election year because we're going to be focused on that. So it actually worked out perfectly that, because the basic thesis of the book, if you want to simplify it, oversimplify it, is stock market's overvalued, and you're going to want to get into gold and precious metals and real assets. And that's kind of what we've seen happen in the first quarter into the second quarter here of 2025. And there's a lot of reasons for it, obviously, with the trade wars and the whatnot going on. But and there's also that government debt was out of control. I guess those would be the three main points. And it's a perfect timing.
It is perfect timing because I feel like this, we're not through all the challenges. As you say, the debt crisis, it's still here. Dodge has hardly made a dent. And there's a Professor St. Ange. I watch his videos. He's got a great Substack of his own. He just noted that all the savings are just being funneled to other spending. So you've got there's a lot of meat in here. So you mentioned it's Humanix Books, so humanixbooks.com. That's the publishing location. So if I'm looking at the contents, so why don't we discuss, because there's a bit more, let's say, sophisticated information here using options, for example, which many investors are not maybe familiar with or not so comfortable going into. But let's set up the context. So you write, this is the end of the debt super cycle. So how does the debt super cycle end?
Well, what's interesting is I had a book called The Great Super Cycle, and I got to be honest with you, I was a little bit wrong at the time, because when they were doing all the money printing after the financial crisis, I thought we were going to have inflation in the 2000 teens, but all that money went into asset markets. It went into the Magnificent Seven, remember FANG stocks before that. So that's what happened there. But one aspect of the book that ended up being right on of that book was, at some point we were going to see the bursting of this bond bubble. You can't just keep these rates at zero forever and borrow money forever. And that finally started to crack in the last few years. So a lot of times these things take longer than you thought, because I was right about that, but it took a decade for that to play out. And so how it ends is, I think, and I don't really talk about this in the book, but this is something that I think is we should discuss, and I've been talking about recently, that when the market went down the other week, what was interesting is wasn't the usual trade where the dollar goes up and interest rates go down and the bonds rally. The dollar went down and interest rates went higher. And in 1956, there was a crisis in Egypt called the Suez Canal crisis, where Egypt was essentially nationalizing the Suez Canal, which were run by French and English, British companies. So then they started a war along with Israel against Egypt, and then the U.S. was against it, and they didn't want another British colonial war. 10 years after World War II ended, and the British had given the Americans had given the British an emergency loan after World War II. And basically, Eisenhower at the time called the prime minister of Britain and said, if you do this, we're going to dump your bonds and you're done. Like your economy is finished, right? And then Britain had to retract, and that was it. And that was even though the British Empire had already been declining, that was kind of the end of it because they couldn't do all these ventures on their own anymore. And I think what would happen is if the bond market reacts, regardless if it's foreign investors or domestic ventures, and spikes interest rates higher, kind of like what happened in the UK when Liz Truss tried to cut taxes without any corresponding spending cuts, and the bonds in the UK spiked in yield, and the pound tanked, and she had to retreat. If that happens, and I think that could happen when Trump tries his tax cuts, because I don't think he has the proper corresponding spending cuts, because as you said, Doge is not doing it, right? So right now the deficit's on the pace to be 2.6 trillion this year. Well, those spending cuts could spike it to close to 3 trillion, which is over 10% of GDP when we're still technically in an economic expansion. We might have started a recession. And just imagine if there's a recession, that will be even bigger because GDP will be shrinking. So I think the bond market at some point is going to react to one of these badly. And then the Fed will have to come in and monetize, and basically buy bonds. And when that happens, I think that's kind of how the debt super cycle kind of blows up, because that means, quantitative easing. Every time there's a crisis, they just print money and borrow money and et cetera. That kind of scenario then kind of ends. And then where do we go from there? Do we have some kind of hyperinflationary crisis happen because, they got to print their way out of it? Or do we have a short-term deflationary bust because, let's say, then there is really spending cuts because they're like, we're broke. We can't afford, 10-year bond is 7%. We can't afford this anymore. And the reason I don't think Doge is working, no offense to Elon Musk, I don't think things are bad enough yet. The reason that Milei can do what he did in Argentina is things in Argentina have been bad for decades, and 50% of the population's in poverty, and people are just fed up. So they're like, take the chainsaw out. And that's how you're going to get out of this longer term. And that doesn't mean like getting rid of transgender studies in Chad. That means like you have to like restructure entitlements. You have to restructure Social Security, Medicaid, Medicare, probably shrink the American empire, shrink that military budget, like really drastic changes to the government. And I think that can only happen, unfortunately, in a crisis.
The 2022 trucker convoy showed many Canadians had reached their limits. The convoy's participants encountered persecution from Ottawa and wondered what to do next. Financial Sovereignty for Canadians assists those looking to take direct action, and it outlines practical strategies. These include wealth protection with precious metals, the swiftest path to the United States, expatriation options in the Americas, censorship-resistant cryptocurrencies, and even the case for provincial independence from Ottawa. This book is a gateway to reclaiming your sovereignty, to being an economic driver and not a passenger. Buy it on Amazon.ca or click the link below.
Yeah, so I tend to agree with you. So basically, you're just referring to the debt supercycle as we've had a sustained era. I mean, let's say almost 50 years or a very long period of time where the United States has enjoyed economic preeminence, and that has enabled deficit spending. And especially over the last 20 years, or 15 years or so, since the global financial crisis, there has been this just very easy money policy. And at some point, as you say, you've got two kind of limits to this. One is inflationary pressure, and the other is the willingness to buy U.S. bonds. And we probably will come to that point in the near future. Already there's been inflationary pressure, and given the magnitude of U.S. debts, you would think that at some point the premium or the risk premium associated with US debts will go up.
I think like what's going on with the trade war is very detrimental psychologically, because first of all, foreign ownership of bonds has gone from about 40% to 22% in the last roughly 10 to 15 years. So what's happening is foreigners aren't selling, but they're not buying. Like they're just kind of rolling over. So I don't think foreigners were dumped like that Suez Canal analogy, but I think more than likely is that most debt is short term orientated. It's 1 to 2 years. So like when like for example, 8 trillion is coming up in the next year. We'll say 2 trillion of that's owned by foreigners. They just might not roll it over. And then they're gonna have to not only roll over that 8 trillion, but they're gonna have to find that extra 2 trillion because the foreigners just won't like buy it and roll it over again. So I think that's the kind of thing you're going to see happen now because there is a lot of trust loss. I don't care if you agree with the tariffs or don't agree to the tariffs. A lot of foreign money and foreign investors and foreign countries now have kind of lost trust in the United States. And remember the whole thing where like Trump will say, "Oh, they're ripping us off." My counterpoint is, look, the whole point of being the reserve currency is all these countries buy your debt, and in terms, they're going to sell you their things, right? That's kind of the trade-off that you have, right? And like the one advantage that the European Union or Canada or Australia or any of these countries have, not being the reserve currency, is their debt is all mostly domestically owned. So they're selling it to themselves. They're not selling it to foreigners. So the advantage of being the reserve currency is you get this foreign money, but then the catch 22 and disadvantage is if something like this happens, that foreign money can leave, right? So, and you saw that in the pound, like when the pound ceased to be the reserve currency, the money left the UK and went into the US. So that's kind of like where we are here, and that's kind of the negative aspect of all of this. And I think the whole thing with trade is I agree with certain industries have to be protected, even though I'm a libertarian. Like I think it makes sense to have your own steel industry, to have your own pharmaceuticals. I don't think you should be outsourcing them. But a lot of things, it's like, come on, like you think that the guy in Bangladesh making $1 in a day making your t-shirts is your enemy? It's like that's not a good life for those people doing that sort of thing. So
Yeah, David, I don't. Yeah, I mean that's a real. It's a really tough topic, the whole tariff situation, because of course it's none of us like taxes, but of course we realize that there's some kind of strategy at play here to try to get other countries to reduce their tariffs and to try to kick China out of certain places. So it's a difficult situation to to give a fully positive or negative review.
yeah, like I said, I think there's positives and negatives to it. I think it's just been done too quickly, too extreme. Like the average tariff is now back to where it was in 19.
It does seem haphazard. Yeah.
Well, there was no income tax in 1900 when tariffs were 25%. The government was 3% of GDP. Now it's 30% of GDP in terms of government spending, federal government spending as a percent of GDP. So, and I live in the Bahamas where we run on tariffs. We don't have income tax here, right? But the thing is, it's a small economy, right? It's a consumer-based economy, with tourism, and you can, and we do have a VAT as well, and you can run the economy on that. And especially in these smaller islands, I don't live in Nassau. I live in an island called Eleuthera. A lot of people don't even have bank accounts. So they won't report their earnings or whatever, but they'll go to the store and buy things. And one thing I'll note, because I don't want to concentrate too much on the Bahamas, but here the tariffs are very strategic. Like high-end goods, like expensive car, are taxed at 45%, where like cell phones have like no tariffs. So a high-end car is some rich billionaire who bought a house in the Bahamas is going to buy it, but everyone has a cell phone. So that's focused on poorer people. These tariffs, just having a blanket tariff, that's another issue as well. But anyhow, to get back to the super cycle thing, I think the real issue is, I think what they're hoping to do partly too is also raise a whole bunch of revenue. And they hope that Doge was going to cut a bunch of spending, and that's not happening. Spending is up like almost double digits year over year in the United States. No one's really talking about that over the first like half of the fiscal year. So spending is not being decreased. And like I said, I think it's the whole Suez Canal, the bond market will have to take the printing press and the spending press away. And I don't know when that's going to happen. And there was a book that stirred my interest in economics when I was a teenager called Bankruptcy 1995 by Harry Figge. I've been worried about this. It was written like in 93. So I've been worried about this for over 30 years since I was a teenager. And they've done quantitative easing, they've done ZERP, they've done all of these things, and they've kept it going. And actually, Figge was right. The debt is actually higher now than he anticipated in like 20, 30 years. And he was obviously using worst case scenario. But because they've been able to use all this financial engineering, they've been able to avoid a debt crisis. But I think now, too, another aspect of it, and another theme of the book is gold and precious metals, is the reason you're seeing this big move like we haven't seen in a long time into gold and precious metals is worries over the debt. I kept telling people, even last year, even before people got worried over the whole tariff thing, why, if we're gonna have all this prosperity and all this boom, why is gold acting so strong? I think the gold market is telling you that it's worried about something, and now even more so.
You imply here from your chapters that this problem of higher, let's say, yield expectations or requirements is going to spread not only to government bonds but to corporate bonds. That's one of the chief elements of the book. Do you want to explain that shift to the corporate bond market?
This is a trade I've been talking about for quite a while, and I've put it on a few times, and I've actually made money on it a few times when interest rates went higher in 2018 and 2020, and or when there was a big drop in the stock market. So I kind of based it off the theory that the guys in the Big Short were using, and their basic theory was that all these MBS, mortgage-backed securities, were rated AAA, right? But in reality, they were all complete junk, right? They were garbage. This theory is that corporate bonds are the A-rated. So this is not junk bonds. This is investment-grade corporate bonds. The A-rated companies, so the Microsofts, the Apples, and other companies, et cetera. They've taken on a huge amount of debt, like the government when rates were low. So now they have abnormal amounts of debt on their balance sheet. And if interest rates were to normalize, so it's like go 6 or 7% from like they issued a lot of these bonds at 2-3%, 75% of investment grade corporate bonds, these companies would actually be debt. Or sorry, junk debt, because their interest expenditure would eat into their revenues and profits and be so high, they'd be like a junk bond. And that means the market would have to readjust to that. And the difference between corporate bonds is, let's say you did get the trade, even though it didn't happen a few weeks ago, where people move into government bonds. That happened in 2008, 2020 when the market tanks. Corporate bonds tanked each time because corporate bonds, obviously, if there's a recession, corporations' revenues go down, et cetera. And again, they'll have this interest expenditure, and then they won't be making as much money to service that. So my feeling is the corporate bond investment grade market, like mortgage-backed securities, is mispriced. And here's the great thing about this trade: the instrument you use is what's called the LQD, which is the corporate bond ETF.
But you have to short that. You have to short that corporate bond ETF, correct?
You could short it, but and they're not overly liquid, so it's more for a small trade to hedge. But if you get because corporate bonds are usually so stable and don't have a lot of volatility, investment grade corporate bonds, the premiums on the puts are very, very low. So even if you just get a 20% drop in them, which is not a huge move, because usually they only move like 5 to 7% a year, that you can make 10, 15 times your money on a put trade, on a short trade using that avenue. Now, the warning is the puts aren't overly liquid. It's something you probably just do with a few $1,000s, but I like it because it gives a small investor, a retail investor, a way to play it. We're like, doing the CDS and all this stuff back. You had to be billionaire and a big fund and all that sort of thing. So it gives a small investor. And like I said, because the premiums are so low, that even if it doesn't move that much, you don't lose. Problem is when premiums are high, like if you try to do puts on a stock like Nvidia, the premiums are so high. If it doesn't move down to your price, you're just going to expire worthless. And so these kind of can keep their value for a longer period of time. And here's another thing about corporate bonds, which is interesting in this a potential meltdown. Those bonds that trade, most people just buy those bonds and then hold them to duration.
You had mentioned basically the put trade and how you said it's not super liquid, it's not super. There are not so many transactions going on in that space. I really, because there's a lot in here, and maybe you want to address a lot of these, let's say, buy and hold retail investors as to, obviously your book has made the case that getting involved in options is a useful element, useful like exercise. Do you want to give some pointers as to how people would even get started doing that?
Well, like I obviously my publication, we do some option trading. What I'm doing in my publication right now is I have two small portfolios. I have a $30,000 portfolio, which has a maximum of 12 positions, and it's a mixture of options, regular trading, IPOs, financings, etc. And then I have a 5,000 mini portfolio, which has a maximum of 5 positions. And I put the Newsmax IPO into both of those because I did it myself and it did well. Because on the IPO, not the pre-IPO, you didn't have to be accredited to do it, right? So anyone could have done it. And you could have done it for as little as $500. So anyhow, one idea I have in the book is straddles. So straddles is, say you buy Microsoft puts, right, or and calls. So then all you really need is like a big move in the stock in either direction. If the stock moves 30% in either direction, you're going to double, triple your money. Now, right now, the issue with I like to do those trades like a month ago when, say, the VIX is 15, 20. The VIX is the volatility index, the premium in the options. The VIX is 30 right now. I went to 60. It's not worth doing it at those levels because the premiums are too high. Now, the LQD trade, the good thing is the VIX premiums have not spilled over into that. So that's a good thing. But for the most part, I would stay away from options when the VIX is that high. You want it really back into the low 20s or teens because when it's at 30, 40, 50, you're paying too high premiums and you're not going to make the money do it. But that's the other idea I have is that if you are somebody still bullish on the markets, you could do the straddle strategy. And if something like NVIDIA goes to $200, you're going to make money on the calls. But if it melts down 50%, you're going to make money on the puts. And obviously, the other side of the trade will expire almost worthless. But if you can make, say, 4 times your money, you'll still double your money on the total trade. So it reduces the total return, but you're not totally exposed to one side of the trade. So, and I give it a couple of examples of like stocks that moved higher and lower and how this would have worked in the book.
Yeah, and for people who are not familiar with this sort of options engagement, typically people, if you have a discount brokerage like a Schwab or the like, they'll have all sorts of tutorials on how you can get started with this. So I just like, as David was saying, just start small. Don't go, don't go. Yeah, because it's just a learning process, and everyone has to go through that journey. To be frank, you kind of like crawl before you walk. And so, but yeah, as you said, the options element is just one portion of the book, and you go through. In some ways, well, you address both the real assets, oil and gas. Then you go through emerging markets, real estate, but you do talk about this new tech, crypto, cannabis, green energy. So you really cover the gamut here. So do you want to touch upon? It seems like everything is getting some attention here. Are you critiquing some of these, saying that these are a bad idea?
Well, with crypto, my issue has been I don't like the altcoins. I think those are a lot of pump and dumps, right? And you can make money if you really know the market, but you have to really know it, right? Because I think I saw a study that 97% of retail investors are losing money on altcoins, right? And most people chase.
Yeah, because there's just they're not efficient markets. Like there's not a great deal of transparency or understanding, and there's just so much, let's say, emotional or herd behavior going on with this. The altcoin space is one of the, let's say, a real haven for all these cognitive biases we have leading us astray, where people think they know more than they do and the like. And I've been very hesitant to get involved with that myself, just because, just like you, I don't feel like I'm some kind of wizard when it comes to the cryptocurrency space.
Well, like when you have something called fart coin, it's hard to take that space, seriously. you know, so,
Yeah.
but then like Bitcoin, I've done the studies on it. It has about a 90% correlation to the Nasdaq. So that is my biggest worry. And it's held up in the second part of the sell-off very well. Like I actually bought the short Bitcoin ETF when I really thought the market was going to tank, and it did, but it only went up a few percent, and I got out of the trade, right? And so, is Bitcoin starting to act like a currency hedge? I don't know. It could be, right? But the last 2 drawdowns we saw in the stock market in 2018 and 2022, we saw Bitcoin go down 70, 80%. So if we see another drawdown of 30, 40% in the Nasdaq or S&P, is that going to happen again? I don't know. But I do know if they reinflate, yeah, you'll definitely want to be long Bitcoin. Right now, too, the problem we have with the whole thing with trade and capital fleeing certain countries, this and that, there's probably like money going into Bitcoin as well, just like it's going into gold as a way to get out of like some of these emerging, even though the US dollars come down against the merged world, the developed world. a lot of the emerging market currencies continue to devalue. So I'm sure in places like Indonesia and India, like some money is not only going into gold, but it's going into Bitcoin as well. So, but like I'm not really a crypto expert. I worked on that chapter with another individual who helped me with it, and I really stick more to equities because cannabis is totally beaten up.
Yeah, I'm just looking at, like I said, your sections here because the first, let's say, almost third is explaining this end of the debt super cycle, the everything bubble, and yeah, how this will spread to corporate debt. And then you go through different investment sectors. And I guess I'm just curious as to, this is mega profits, what is the most, what are the most compelling portions that people should really take a look at?
I use a study by a guy named Maybean Favor, so not Mark Favor, Maybean Favor, who runs some funds in the U.S. And his study shows what happens to assets and markets when they go down like 60, 70, 80, 90%. And what they show is the 2 to 3 year returns off that are usually in the hundreds of percent, right? And I'll give you an example. Like if you go to my YouTube page, you'll see that I did a video on Fubo, which is a streaming service in the United States. And last summer, it was my favorite stock. And I talked about it on $1.40, $1.50, and it spiked to over $5 where we sold it on news that they had a deal with Disney. But Fubo had come down from $60 to $1.40. It was beaten up. It was trading at a quarter of revenues. They're still growing their revenues at 20% a year. They had an antitrust lawsuit against Disney because Disney was trying to do this sports streaming service that Fubo had said that they had offered, like they wanted to do through these companies and ESPN, NBC, anyhow. And Fubo was saying, "Hey, we wanted to do this," and then you guys turned around and said no, and now doing it yourselves. So you try to put us out of business. So I think they were going to win it, and then so I think they made a deal with Disney, and the stock showed up. So I saw the antitrust trial, plus the fact the company was still growing as catalysts, and like I said, it was trading at a quarter of revenues. So then the stock went from, like I said, $1.40 to over $5. So that's the kind of strategies to find beaten up assets that also have some kind of catalyst, because a lot of assets can stay cheap for a long time, right? A catalyst that can potentially say send them higher. Like another analogy I use is, so John Templeton, his first famous trade was he bought 100 stocks trading at under $1 in the late 1930s, thinking the economy was going to come out of the depression because of all the movement to basically arm Europe during the World War II, right? Arm the Allies, arm France, arm UK, etc. And on average, he borrowed $10,000, which probably would have been like over 100,000 at the time, and he made something like I think he made like 4 or 5 times on the trade in a few years at a time when the stock market basically stayed flat over those years, because these companies, a lot of them were railroads that were in bankruptcy, came out of bankruptcy and soared in price. So that's the kind of thing I want to do with Maximum Pessimism. Like right now, I got to leave this for paying subscribers, but I have a company I really like. It's actually in the finance newsletter industry, but it's trading at 4 times earnings. It pays an 8% dividend, and they're starting to turn around the business. And I think, and it's trading at like less than half of their revenues. So I think this is the kind of thing that can go up 5, 6 times in price. So that's kind of like, that's a lot of the thesis of the book, that being patient, don't have to chase NVIDIA, you don't have to chase Amazon, being patient and looking for these beaten up assets. And the last thing I'll say here, even since 2009, when we've been this huge bull market for equities, this bubble, in 2012, you had Europe. In 2014, you had Russia. In 2015, you had commodities. And then actually in 2020, you had uranium. So you had, and your oil as well, when oil went negative. So you have had all these sectors and certain markets that have been good buys that did well over a 2 to 3 year period, even when stocks remained overvalued.
When you say pessimism or profit from pessimism, can we classify these as value stocks then? Does it fit into that value versus growth dichotomy?
I think it's value, but not value like it's got to also be like something that's like people are very negative and hated on too. Because I think that sentiment factor of it, like, no, because people shorts, people don't want anything to do with it, and that can turn it around quite quickly, right? Like in 2011, I was lucky. I bought this house in the Bahamas at the bottom. It was totally luck. I had a mining deal that did very well, and it allowed me to purchase this house. And at that time, Canadian dollar was still par, so I could just convert my money and then I'd use that as my down payment. And then I looked at the chart of like U.S. housing prices, and the Bahamas just tracks. We're so close; it just tracks the U.S. I was like, I literally bought my house the month of the bottom, right? And it was total luck. But again, why did housing bottom? It was no one wanted to buy houses in 2011 after the financial crisis. It was like totally hated, and like a lot of the housing stocks, like the home building stocks, went up 500, 1,000%, right? So I think it's not just value stocks. You want to have that negative sentiment. Like I did a conference in the Bahamas in 2009. And this was 2 or 3 weeks. It was in late March. It was 2 or 3 weeks after the bottom in the markets. I was the only one bullish there. And I wasn't like this whole bull market for 16 years, was way wilder than I ever expected. But I was bullish for say 2 to 3 years going out. And I was the only one bullish there. I just want to say the difference between buying pessimism and buying just a value stock is you could buy, I don't know, like Pfizer, right? The last 5 years, and it's a value stock, right? And it's underperformed the market. Where when you're buying pessimism, you're looking for something that's really out of favor and has dropped that 80 to 90%. Because you can have a stock like I own Altria, which was Philip Morris, and that's a value stock, but that's near its highs. So you can own a stock like that. That's a value stock. That's not necessarily pessimism.
That's right. I agree. I'm familiar with Altria, and it is, as you say, it would be a value stock, but it's just kind of like a permanent value stock. It's not like anyone's beating up on it or anything like that. Yeah. So, yeah, the book is Mega Returns: Profit from Pessimism, and it is on Amazon. We'll have links in the show notes. And also, you can go to humanixbooks.com. And so my understanding, David, basically is that you're explaining the end of this debt super cycle. It's a cannibalism into the corporate debt market or corporate bonds, and then identifying these firms that have both value and negative sentiment to find the real earnings opportunities.
Here's another interesting part of that trade with the maximum pessimism is sometimes you'll have stocks that are going down during an entire, say, market move, bull market, and then they kind of get that final flush at the end of the bear market. And because they are so beaten up, they're the ones that lead. Like it's like I guess George Soros would call it reflexivity. Like that's his term is like everything reflexes to the other side. So sometimes I have a few companies like that on my watch list right now. Like I have a 3D printing stock I like that I don't own at the moment, but it's gone from $100 to like $2. So that's the kind of stock that could go to 50 cents in a bear market. And because it's already that's it, it's bottomed out. It can lead on the way higher. So that's another trading strategy I use. And I like to go to something just quickly because I think it's an important part of the book too. Is I have a chapter on what I call hyper normalization, which is also part of. There's a great documentary maker in the UK named Adam Curtis, and he has a documentary with the same name. And one thing that like Trump's trying to use right now, that they're trying to use is that the economy was kind of fake because, and I agree with this by the way, because we've used all this government spending and cheap money, and it's kind of been propped up. But also because of the cost of living increases, even though they're telling you the economy is growing, the stock market's at all-time highs, people don't feel that way, right? That's why populists like Trump or Milei in Argentina or the woman in Italy. That's why these people have been winning elections. That's why Farage is popular in UK as well. People don't feel good, right? And I talk about this hypernormalization that all this cheap money, and I'm using it from an economic standpoint more than Curtis, kind of created this fake economy with inflated housing prices, real estate prices, asset prices, etc. And it's benefited the few rich people, but it hasn't benefited most people. And I think that's why we're going to see all this turmoil because people want change. They want something different. And maybe through these tariffs or through whatever the case may be. But I think now the hypernormalization is hitting home and we're going to see these big disruptions because people are kind of fed up. And a lot of people may not know why things are bad, right? But I think like the high cost of living and the whatnot's a big reason. And here's one thing I think is going to be really interesting going forward. I know you talked about like I'm Canadian, right? Is that one thing that's going on in the Canadian election is it's flipped. The young people are voting conservative and the baby boomers are voting liberal because they want their entitlements, right? And And I think I've always been waiting for kind of the end. Like I said, we need a crisis and get rid of the welfare state if you're going to get out of this debt cycle. Well, maybe young people will be like, screw you. Like the next election, like I don't care about free health care. I don't care about these programs because you bankrupted the country with all this stuff, and I don't want to pay taxes for it anymore. And yeah. So maybe like as obviously the baby boomers will begin to die off, and young people become a bigger part of the demographic. Maybe that's how also you get this shift to a more kind of like you could say conservative libertarian type economy as well on top, and the debt crisis pushes you into that as well.
Yeah, the key distinction you're touching upon that people perceive but don't necessarily understand is between asset prices and actual production, right? So if people are not don't have the right capital at their disposal or the right skills, they're not going to be productive. Their salaries or earnings are not going to be going up, or maybe there won't be a competitive enough labor market to really compensate them for their worth. So they realize that they're not getting what they feel like. They see all these share prices or house prices going up, but they're not the ones enjoying the fruits in terms of actually producing anything. So there is that distinction there. And Stephen Harper actually wrote about this in his book, Right Here, Right Now, and which was a little bit of a populist, almost like Canadian populist book. Yeah, the website is Profit from Pessimism. David Skarica, he's also on X, somewhat active there. Yeah. Is there any other platform people should go? I mean, you've got an email newsletter, so go to Profit from Pessimism and get on the email updates. Yeah.
We just set up like a YouTube page. Sorry, no, the YouTube page has been there for a while. We just set up like an Instagram page and all that. I'm not overly active on those because we just set it up. But and to be honest, other than X, I just whatever, Facebook and Instagram. I have no use for all that stuff.
I think your website with the YouTube channel and newsletter plus X is a lot. So those are the places to go: the Profit from Pessimism YouTube, the website, and X. And as I said, the book is Mega Returns: Profit from Maximum Pessimism. David Skarica, thanks for sharing your time, mate, and best of luck with the sales. I look forward to next time we get to chat.
Yeah, thanks for having me.